Good afternoon, social media friends. I'm Kim Carmen with Mortgage Investors Group. I'm the sales manager at the Bearden branch. Last week, our phones started blowing up after local and national news outlets began reporting on the pending LLPA adjustments. While this change is something that most loan officers have already known for about 60 days or so, the general public seems to be somewhat startled. I heard a lot of good questions, but I've also heard a lot of bad information. When we have changes like this in the mortgage industry, I have always appreciated going to the old mortgage coach, Ronnie Wilson. Fortunately, I've recently talked him into coming to work with me again, and it's nice to be able to bounce these things, this kind of stuff off of him. Ronnie has a knack of simply explaining complex things to us in a much more simple way. Also, he does a really good job of explaining practical implications that some of these changes may have on our industry.
I would agree.
And he is modest too.
I would agree with you again. So I think the last time that we did a video was when you were doing your Why No Wednesday videos. Is that right?
Yeah, it was Thursday.
Thursday. Okay. Well, same difference.
So anyway, let me ask you this.
Okay.
So we're hearing all kinds of things regarding this. From this is a tax on good credit borrowers to is this going to cause another housing crash? Do I need to lower my credit score?
I've heard them all.
Where would you start on all this?
Well, I think the first place that I would start for loan officers and real estate agents, people who are counselors or advisors, I mean, we're trusted, and we need to be giving out good information based on facts and not based on our personal biases or just being swayed by political shenanigans, right?
Totally agree.
And so then I think the second thing that I would talk about is how or exactly what LLPA is and how it affects interest rates. Okay, what you're going to find is that these adjustments aren't as dire or severe as what a lot of people believe. You can define interest rate as the price for risk. And so what loan level pricing adjustments, LLPA, what those do is help lenders mitigate risk, and they help them price that risk. All right. Riskier borrowers, riskier applications, they get higher interest rates. Okay. The less risky you are, the lower rate that you get. And that really hasn't changed. So I'm gonna let you guys behind the mortgage curtain here for a little bit. See how the wizard works with all of these pricing adjustments. All right, so I'm gonna show you guys a graphic. It is the current LLPA adjustments. A few things that I want you to know. Every interest rate has a price, okay? The price for a particular interest rate is determined by these loan level pricing adjustments. Let's look at this graphic, and I want you to assume that everybody's getting a 6% interest rate. If you look in the left-hand column, you're going to see all of the credit scores. You're going to see different credit score levels. If you look across the top, you see percentages. Those are the loan amounts relative to the purchase price. Now, if you take that percentage, you see that one on the left, Kim?
Yeah.
That's a less than or equal to 30%.
Right.
All right, so that means somebody's putting down 70%. If somebody puts down 70%, you can go straight down that column, and nobody is paying anything extra for a par rate of 6%.
No matter what the credit score.
No matter what their credit score is. Right. Slide over one column. Now that's people who put down 69 to 40%.
Okay.
They're pretty much nobody there is paying an adjustment either, except for that bottom tier of 639.
Okay.
Now I want to move all the way out to the right. That's for the people who are putting down 5%. Okay?
Oh, yeah.
You can see how those pricing adjustments work, all right? And what you're seeing is that the higher credit borrower is paying less of an adjustment.
Absolutely.
Okay? Slide over there to the column where it says 75.0 to 80%. This is for the people who are putting down 20%, right? 100% minus that 80%, that leaves a 20% down payment. You are looking at the current loan level pricing adjustments. And what you're seeing is that the higher credit scores are still paying less than what the lower credit scores at the bottom of the matrix are paying. So again, keep in mind, you can see from this chart that the better your credit score is, the better your interest rate is, all right? These are the current adjustments. So any reports that a worse credit score gets a better rate are just not accurate.
So what has happened then?
Well, Fannie Mae and Freddie Mac, they are two government-sponsored entities. And so they handle conventional mortgage lending, and they are saying that they have reviewed delinquency data and that they are making adjustments to pricing that is reflective of revised risk levels.
And it's the adjustments that's got everyone freaking out?
It's the adjustments that have everybody freaking out. These are much more minor than what people are thinking. First of all, these adjustments only apply to conventional financing. It's not FHA, not USDA, not VA. Look at this slide right here. These are all of the conventional LLPAs that we deal with, okay? Credit score and down payment are only two of the factors we use to gauge risk.
We also look at debt ratio, occupancy, property type, all that stuff.
Absolutely, absolutely. All of these items here are LLPAs, and what we see, the recent changes only apply to the areas in yellow. In fact, the only negative changes are those that are here in red. So these are the ones that are getting people flustered. What they reflect is that these borrowers with these scores in these down payment ranges have been deemed riskier than what Fannie Mae and Freddie Mac originally thought. Basically, they're not performing like Freddie and Fannie thought that they would, and so their pricing adjustments have gone up.
Okay, so ironically, these with lower credit scores have gone down.
Yes. And so apparently, what Fannie and Freddie would have us believe is that these lesser credit scores, not that they're less risky, but that they've just performed better than what they originally had thought and how they had originally priced it.
Okay, that seems convenient.
It seems very convenient. You can see how this could get spun easily. I do have another theory, but I want to show you something else on this next graphic right here. This is one of the good things that has come out of it. Now, if you have a score above 760, you actually get better pricing than a borrower with a score between 740 and 759.
All right, we didn't have that before. Usually, if you were above 740, you were getting premium pricing no matter what. But if I'm reading this right, you are now saying that there is a reason to increase your credit score as high as you can.
Absolutely. I would also have you look at this bar column over here to the right. All adjustments there are positive, basically meaning that the pricing has gone down. So if you have 5% down or even 3% down, you're getting more favorable pricing now after these May 1st adjustments. This is what loan officers and real estate agents can really start conveying to potential homeowners.
All right, so it's now cheaper than it was if you have 5% or less down.
Absolutely. Across all credit scores, right? This is across all credit scores. So if you have someone waiting for rates to go down, this is their chance, so to speak.
Okay. All right. It seems like lower down payments would be more risky though. What am I missing?
Well, you're right. And again, keep in mind what Fannie and Freddie is saying is that these lower down payment programs have performed better than what they thought they were going to. And so therefore they're making these adjustments. Or it could have to do with my other theory.
Do tell.
All right. So again, this is my opinion, and there's others in the industry who agree with this. And so FHA has recently gotten more competitive by lowering their mortgage insurance premium, and I think that Fannie and Freddie want to get into that game more and be more competitive. Right now, credit score borrowers at 660 or less, FHA is just a better way for them to go. They get a lower payment. The down payment requirement is less. The credit requirements are less. There's more flexible underwriting guidelines.
So that could be very true because most of my borrowers that I have between a 620 and a 660 credit score, they're much better off going FHA or considering the THDA program because of the LLPAs.
The LLPAs make it just almost unfathomable to even think about doing. So you can usually follow the money and eventually get to the root of many business decisions. I think that one of the reasons why they made a higher adjustment to the higher credit score borrowers is because they're more likely going to refinance. And so they're trying to get some of their money up front, right? You will also notice that if you look at that 75 to 80% range, you're going to notice the adjustments higher than if somebody only put down 10 or 15%. Do you know why that is?
No.
It's because there's no private mortgage insurance on a loan that's 80%. And so they're figuring, hey, this is more risky to us.
So what you're saying is if someone asks about lowering their credit score to get a better rate,
I would say that's absurd. It's not even accurate, right? Remember that first graphic that I showed you? You don't get a better rate by having a lower credit score. Okay, just your adjustment has just changed negatively just recently. In fact, you get more favorable underwriting conditions. You get better mortgage insurance premiums, lower homeowners insurance premiums, higher debt ratio, lower reserves. I mean, there's no reason to intentionally lower your credit score ever.
To those who think this is creating a housing bubble.
Well, that's probably coming from your sky is falling crew, right? The sky's always falling with some people. That's just not the case either. Last time we had a slew of no down payment programs. We had mortgages that didn't require income verification, stated income loans. We had lenders that were specifically ordering appraisals from appraisers to inflate values on the home. And so there was a lot of shady things going on with hedge funds and subprime lenders, and we just don't have to worry about that at this point.
So you're saying all is good, basically, that just don't believe everything you read.
That's
everything you hear.
That is definitely what I'm saying. And so if you're currently looking for a home and you're not sure about these pricing adjustments, if you already have a rate quote, one thing I have found out about working in the Bearden branch is that everybody knows a loan officer for Mortgage Investors Group at the Bearden branch. And so ask them to give you a second opinion. If you know your credit score and you know what kind of a program you're doing, it should only take about 5 minutes to get a second opinion.
Okay, you're the best, Coach. That's why we have you.
Thank you.
So if there's anything we can do out there for you all, or if you're a real estate agent and you have any questions or anything for your clients, just give us a call. Thanks again, Coach.
Thanks.